This video is for anyone preparing to sit for the Minnesota State portion of the Life Insurance Producer Exam. Everything here is built around one job, getting you ready for the questions Minnesota writes about its own laws, its own numbers, and its own rules. We are going to stay tightly focused on what makes Minnesota different. The national material, how whole life works, what a beneficiary is, how underwriting classifies risk, you are studying separately, and we are going to assume you have that side covered. What we add is the Minnesota layer, the roughly 1/3 of your exam that trips up candidates who studied hard but studied generic. Minnesota gives you 75 scored questions on the life exam, and 25 of them are state law. That is a quarter of your score riding on the material in this video, so let's make those 25 questions the easiest ones you answer all day. Start with a difference that catches people off guard. In most states, you would look for a Department of Insurance. Minnesota does not have one. Insurance here is regulated by the Minnesota Department of Commerce, and the official at the top is the Commissioner of Commerce. When your exam refers to the Commissioner, that is who it means, the Commissioner of Commerce, appointed by the Governor. If you see an answer choice that says Commissioner of Insurance, be careful, because Minnesota's title is Commissioner of Commerce. What does the Commissioner actually do? Think of 3 buckets. First, broad regulatory power. The Commissioner enforces every insurance law in the state and can investigate, examine company and producer records, and hold hearings. Second, gatekeeping. The Commissioner licenses producers and grants insurers their authority to operate. Third, discipline. The Commissioner can censure, suspend, revoke, or refuse to renew a license and can levy civil penalties. Hold on to that phrase, civil penalty, because Minnesota leans on financial penalties as an enforcement tool, and we will see specific dollar figures later. So the takeaway from this short section is mostly vocabulary, but it is vocabulary the exam tests directly. Department of Commerce, not Department of Insurance. Commissioner of Commerce, not Commissioner of Insurance. Get those 2 right, and you have already banked points. Studying for your insurance licensing exam? Check out the My Insurance Guide flashcards app, built specifically to help you pass your insurance licensing exam with confidence. Master over 1,000 expertly curated flashcards across every insurance line. Built-in spaced repetition brings back the tough terms right when you need them, and timed practice exams prepare you for the real thing. Click the link below and download today. Now, back to the video. Now, let's walk the path to a license, because Minnesota attaches specific numbers to almost every step, and those numbers are exam gold. Before you can sit for the exam, Minnesota requires 20 hours of approved pre-licensing education for each line of authority you want. That is 20 hours for life. If you also wanted property, that would be another 20. The number to lock in is 20 hours per line. And here is a Minnesota wrinkle worth remembering. That pre-licensing course cannot be one sponsored by or affiliated with an insurance company or its producers. The state wants your foundational education to come from a neutral source. Once you pass the exam, your passing result does not last forever. In Minnesota, examination results are valid for 3 years from the date of the exam. We will say that again because it is a favorite test point. Your exam results are good for 3 years. If you let more than 3 years pass before you complete your license application, you would have to test again. Now, the license itself. A Minnesota producer license is issued for a 2-year term, and here is the part that surprises people. It expires on the last day of your birth month. Not a fixed calendar date for everyone, but your own birth month, every 2 years. So if you were born in March, your license expires the last day of March in your renewal year. Birth month, biennially, that is the Minnesota renewal clock. Let's talk about appointments, because Minnesota draws a clean line here. You can obtain your producer license on your own, before any insurance company is involved. But you cannot actually transact business for an insurer until that insurer appoints you. An appointment is the insurer's formal authorization for you to represent it. Picture this. You pass your exam, your license is issued, and you are eager to write your first policy. A neighbor asks you to sell them coverage from a particular company. Can you? Not until that company has appointed you. The license makes you eligible. The appointment makes you active for that insurer. And this connects to a concept the exam loves. Once you are appointed and acting, you are the agent of the insurer, not the agent of the insured. You represent the company. So, when a question asks whose conduct the insurer is responsible for, the answer flows from that rule. The producer acts as the insurer's agent. Two more licensing rules carry specific numbers, and both reward memorization. First, the lapsed license. If your license lapses because you missed renewal, Minnesota gives you a window. Within 12 months of the renewal due date, you can reinstate without taking the exam again. But there is a price. You pay a penalty equal to twice the unpaid renewal fee. So a late renewal costs you the renewal fee plus a penalty of double that amount. 12 months to reinstate without retesting, at double the fee. That is the rule. Second, revocation. If the commissioner revokes your license, you cannot even reapply for at least 2 years. And when you do reapply, Minnesota requires you to post a performance bond of $20,000 or more if the commissioner decides more is warranted to protect the public. So revocation is not a brief timeout. It is a 2-year bar followed by a $20,000 bond. The exam pairs those two figures, so keep them together, 2 years, then a $20,000 bond. Let's recap this section's numbers, because there are several and they matter. Prelicensing is 20 hours per line. Exam results are valid for 3 years. The license term is 2 years, expiring the last day of your birth month. A lapsed license can be reinstated within 12 months at twice the renewal fee. A revoked license means no reapplication for 2 years and then a $20,000 bond. Mix those up and you will lose points, so drill them. Once you are licensed, Minnesota keeps you sharp through continuing education, and the rules here are precise. Every licensing period, which is that same 2-year cycle, you must complete 24 hours of approved continuing education. Of those 24 hours, at least 3 must be in ethics. We will repeat the core number, 24 hours every 2 years, with 3 in ethics. There is also a limit on where those hours come from. No more than 1/2 of your required hours may be company-sponsored, that is, courses offered by or affiliated with an insurance company. Half of 24 is 12, so at most 12 of your hours can be company courses, and the rest must come from neutral providers. The reasoning is the same as the prelicensing rule. Minnesota wants a chunk of your education independent of any single insurer's sales interests. Beyond the general 24 hours, Minnesota layers in special training for specific products, and life producers run into 2 of these. The first is annuity training. Minnesota has adopted what is called the best interest standard for annuity sales. And before you can sell, solicit, or negotiate any annuity, you must complete a one-time, 4-credit annuity training course approved by the commissioner, often titled Best Interest Standards of Conduct for Annuity Sales. Here is the timing rule the exam may test. If you already held a lifeline of authority at the end of 2022 and wanted to keep selling annuities, you had to complete the training by mid-2023, and if you obtain your life license on or after January 1, 2023, you may not sell any annuity until that 4-credit course is done. So for a new producer today, the rule is simple and absolute. No annuity sales until the 4-credit best interest training is complete. The second is long-term care training. Long-term care insurance helps cover extended care like nursing home or in-home assistance. Before you can sell it, Minnesota requires an initial training course, and then ongoing training every 24 months after that to keep selling. So long-term care is an initial course plus a refresher every 2 years. Recap the training numbers: 24 hours of continuing education every 2 years, 3 of them ethics, no more than 12 from company-sponsored courses, a one-time 4-credit annuity course before any annuity sale, and initial plus ongoing long-term care training with the ongoing piece every 24 months. Let's set the stage for how insurers operate in Minnesota, then spend most of our time on the single most heavily tested marketplace topic, the Guaranty Association. Quickly, the marketplace vocabulary. An insurer that has been granted authority to do business in Minnesota holds a certificate of authority and is called an admitted or authorized insurer. An insurer without that authority is non-admitted. This matters for the Guaranty Association, so keep it in mind. Now, the main event. When an insurance company becomes insolvent, meaning it fails and cannot pay its claims, Minnesota policyholders are protected by the Minnesota Life and Health Insurance Guaranty Association. Every insurer admitted to sell life, health, and annuity products in the state must belong to it, and the surviving members are assessed to cover the failed company's obligations. The exam tests the dollar limits hard, so let's lock them in, and notice that one of Minnesota's numbers is higher than the figure you may have memorized from national material. The overall cap is $500,000. That is the most the association will pay for all policies on any one life with the same insurer. Within that ceiling, the specific limits are these. For life insurance death benefits, the association covers up to $500,000. Notice that figure, $500,000 in death benefits. National study material often quotes $300,000, but Minnesota's limit is $500,000, so set the smaller number aside here. For the net cash surrender value of life insurance, the limit is $130,000. For annuity net cash surrender value, the limit is $250,000. And for annuities that are part of a structured settlement, the protection is $410,000 in present value. Let's drill the four you most need: $500,000 overall, and for death benefits, $130,000 for life cash surrender, $250,000 for annuity cash surrender, $410,000 for structured settlements. Say the death benefit number one more time: $500,000 in Minnesota, not $300,000. One conduct rule rides along with the Guaranty Association, and it is a classic trap. You may not use the existence of the Guaranty Association to sell or advertise insurance. You cannot tell a prospect, "Buy from me, you're protected by the State Guarantee Fund." Using that protection as a sales pitch is a prohibited practice. The association exists as a safety net, not a marketing tool, and the exam will test whether you know the difference. In the next section, we shift from the marketplace to the contract itself, and to the policy provisions Minnesota writes into every life policy, starting with a grace period that Minnesota states in a way you should not gloss over. Minnesota law spells out provisions that every life insurance policy issued in the state must contain. These overlap with national concepts, so our job is to nail the Minnesota specifics and the exact language Minnesota uses. Begin with the grace period. The grace period is the stretch of time after a premium due date during which the policy stays in force even though you have not paid. Minnesota requires a grace period of 1 month for every premium after the first. Hear the phrasing. Minnesota's statute says 1 month, not a flat 31 days the way some states word it. For exam purposes, treat it as a 1-month grace period, and know that if the insured dies during that grace period, the policy still pays, though the company can subtract the overdue premium from the benefit. Let's make that concrete with a scenario. A premium is due on the 1st of June, and the policy owner does not pay it. On the 20th of June, still inside the 1-month grace period, the insured dies. Is the death benefit payable? Yes. The policy was still in force because the grace period had not run out. The insurer simply deducts that one unpaid June premium from the amount it pays the beneficiary. So, a death inside the grace period is a covered death. The benefit is payable minus the premium that was owed. Next, incontestability. After a policy has been in force during the insured's lifetime for 2 years, the company can no longer contest it for misstatements in the application. 2 years, that is Minnesota's incontestability period. After those 2 years, even an honest mistake or a misrepresentation on the application generally can no longer be used to deny a claim, with narrow exceptions like non-payment of premium. If a question asks how long the company has to contest the policy, the Minnesota answer is 2 years. Now, misstatement of age, a favorite because it asks you to reason, not just recall. Suppose the insured understated their age on the application, so the premium charged was too low for their real age. Minnesota does not void the policy. Instead, the benefit is adjusted to the amount the premium actually paid would have purchased at the correct age. So the insurer does not refuse to pay and does not simply pay the full face amount. It pays what the money would have bought at the true age. Reason it through and the answer follows. The death benefit is scaled to reflect the correct age. A couple more provisions to know by name. The entire contract provision means the policy plus the attached application is the whole agreement. The company cannot rely on outside documents, and statements in the application are treated as representations rather than warranties, so an honest mistake does not automatically void coverage. Reinstatement allows a lapsed policy to be restored under stated conditions, such as proving insurability again and paying the back premiums that were missed. And on policy loans, Minnesota lets the company defer paying out a requested loan for up to 6 months, unless the loan is to pay a premium. Let's recap the must-know numbers from this section: a 1-month grace period and a 2-year incontestability period. And the must-know logic: misstatement of age adjusts the benefit to what the premium would have bought at the true age. Those points show up again and again. This section is short, but it is one of the most reliably tested Minnesota differences, so give it your full focus. Minnesota gives the buyer of a life insurance policy a right to cancel, what you may know as the free look period. It is the window after delivery during which the owner can return the policy and walk away with a full refund, no questions asked. Here is the Minnesota number. The right to cancel must give the owner a minimum of 10 days, counted from the date the policy is received. 10 days on an ordinary new policy. But, and this is the trap, if the policy is a replacement policy, meaning it is replacing existing coverage, the window stretches to a minimum of 30 days. So, 2 numbers, and the exam will try to make you pick the wrong one. 10 days for a standard policy, 30 days when it is a replacement. If you see 30 days in an answer, ask yourself whether the question described a replacement, because that is the cue. When the owner cancels within the window, the policy is void from the beginning, as if it never existed, and the insurer must return everything the owner paid, generally within 10 days of getting the policy back. This right is non-waivable. The buyer cannot sign it away, and a producer cannot ask them to. And there is a backstop. If a policy is sold without giving the required right to cancel notice at all, the buyer can cancel for up to 1 full year. So skipping the notice does not shorten the buyer's protection. It dramatically lengthens it. Recap: 10 days to cancel a standard life policy, 30 days if it replaces existing coverage, full refund, cannot be waived, and a 1-year cancellation right if the notice was never given. Lock in 10 and 30. 3 related protections live here, and the first one is a clean Minnesota versus national contrast: the suicide provision. A life insurance policy may exclude or restrict the death benefit if the insured dies by suicide within a set period from the date of issue. In many states, and in much national material, that period is 2 years. In Minnesota, the period is 1 year. We will repeat it because the contrast is the whole point. Minnesota's suicide period is 1 year, not 2. And if the insurer does deny the death benefit because of suicide within that first year, it must refund all the premiums that were paid for that coverage. So the beneficiary is not simply left with nothing, the premiums come back. If you remember one thing here, remember that Minnesota's suicide window is 1 year. Next, protection from creditors. Minnesota law shields life insurance proceeds and certain values from the creditors of the insured and the beneficiary, within limits set by statute. The practical idea for the exam is that life insurance is given a measure of protection so that the money reaches the family it was meant for, rather than being swept up by outside claims. This is sometimes called the spendthrift protection. And beneficiaries. Minnesota recognizes the designations you would expect: primary and contingent, revocable, and irrevocable. A revocable beneficiary can be changed by the owner at any time. An irrevocable beneficiary cannot be changed without that beneficiary's consent. Do not confuse those two. The exam likes to pair a fact pattern with the wrong one. Revocable means changeable at will. Irrevocable means locked in without consent. Recap the number that anchors this section. The suicide provision in Minnesota runs 1 year from issue, and a denied suicide claim returns the premiums. Replacement is when a new life insurance policy or annuity is bought and an existing one is dropped, lapsed, or changed to pay for it. Minnesota regulates replacement closely because a bad replacement can cost a consumer a new contestability period, new surrender charges, and lost benefits. Expect several questions here, and they tend to be about the producer's specific duties and the timing. When replacement is involved, you as the producer have clear obligations. At or before the time you take the application, you must present the applicant with a notice regarding replacement. That notice has to be signed by both you and the applicant, and it must list every existing policy being replaced, identified by the insurer's name, the insured, and the contract number. You leave a copy with the applicant, and you submit a copy of that signed replacement notice to the replacing insurer along with the application. So the duty is, complete the notice, both sign it, list the existing coverage, leave it with the client, and send it in. The application itself must capture 2 statements: whether the applicant is replacing existing coverage, and whether you, the producer, know or suspect replacement is involved. Those questions exist, so replacement cannot happen quietly. Let's walk a quick scenario. A client tells you they want a new policy with your company, and to fund it, they plan to drop a policy they already hold with another insurer. That is a replacement, full stop. So before or at application, you fill out the replacement notice, you both sign it, you list that existing policy by insurer name and contract number, you hand the client a copy, and you send a copy in with the application. Skip any of those steps, and you have committed a violation even if the new policy is genuinely better for the client. The replacing insurer then has its own clock, and this is the timing figure to memorize. The replacing insurer must notify each existing insurer of the proposed replacement within 5 working days. 5 working days, that gives the existing company a chance to contact its policyholder and present the case for keeping the coverage they already have, which is called conservation. And the replacing insurer must give the applicant an unconditional refund right of 30 days. That 30-day figure should sound familiar. It lines up with the longer free look window we saw for replacement policies. Recap the replacement numbers and duties. Present and co-sign a replacement notice listing all existing coverage. The replacing insurer notifies each existing insurer within 5 working days, and the buyer gets a 30-day refund right. 5 working days and 30 days are the figures to carry into the exam. Annuities get their own rules in Minnesota, and the framework here is newer and consumer-focused, so the exam tends to test the concept and a few key duties rather than a pile of numbers. Minnesota follows a best interest standard for annuity recommendations. Here is what that means in plain terms. When you recommend an annuity, you must act in the best interest of the consumer, and you may not put your own financial interest or the insurer's ahead of the consumer's. Minnesota law says you satisfy the best interest standard when you meet 4 obligations. The first is care. You make a reasonable effort to understand the consumer's financial situation and needs and have a reasonable basis to believe the annuity fits. The second is disclosure. You tell the consumer about your role, your compensation, and the product's material features. The third is conflict of interest. You identify and manage conflicts rather than letting them drive the sale. And the fourth is documentation. You record the basis for your recommendation. Care, disclosure, conflict of interest, documentation. Those 4 are worth memorizing as a set. One important clarification the exam may probe: this best interest standard is not the same as becoming a fiduciary. Minnesota's statute specifically says it does not create a fiduciary relationship. It is a statutory obligation to act in the consumer's best interest, which is a meaningful duty, but the exam may offer fiduciary as a tempting wrong answer. The standard is best interest, defined by those 4 obligations. Minnesota adds heightened protection for older consumers. When the consumer is 65 or older, a replacement or exchange of an annuity gets extra scrutiny. A producer should not push a replacement that forces a surrender charge unless it delivers a genuine, substantial benefit to that consumer. The idea is to stop churning that drains a senior's savings through repeated surrender charges. And remember, the training rule from earlier connects here. Before you sell any annuity, you must have completed the one-time 4-credit best interest annuity training. No training, no annuity sales. One more prohibition that is distinctly Minnesota. You cannot sell a life insurance product and an annuity tied together as a single package, and you cannot condition the sale of one on the sale of the other. They must be 2 separate, distinct transactions. Tying them is treated as an unfair and deceptive practice. Recap the annuity essentials. Act in the consumer's best interest through care, disclosure, conflict of interest management, and documentation. It is a statutory duty, not a fiduciary one. Extra protection applies at age 65 and older. Complete the 4-credit training first, and never tie a life sale to an annuity sale. Minnesota, like every state, forbids a list of unfair and deceptive practices, but you need to know how Minnesota names them and the specific timeframes it attaches to claims handling. Start with the conduct that gets producers in trouble most often. Rebating is offering a customer something of value not stated in the policy, a cash kickback, a gift, a share of your commission, to induce the sale. In Minnesota, that is prohibited. Misrepresentation is making false or misleading statements about a policy's terms or benefits. Twisting is a specific kind of misrepresentation using false or misleading statements to convince someone to drop one policy and replace it with another. Defamation is making false, damaging statements about another insurer. And unfair discrimination is treating individuals of the same class and same life expectancy differently in rates or terms. Learn those names because the exam often gives you a scenario and asks you to label it correctly. A producer shaving commission to close a deal is rebating. A producer bad-mouthing a competitor's solvency to flip a policy could be both defamation and twisting. Now the claims side, where Minnesota gives you concrete clocks. The state defines unfair claims settlement practices, and a few timeframes are exam favorites. After receiving notice of a claim, an insurer must acknowledge it within 10 business days and promptly provide the necessary claim forms and instructions. Once an amount has been agreed upon in settlement, the insurer must issue payment within 5 business days. And when the commissioner sends an inquiry about a claim, the insurer must respond within 15 working days. So 3 numbers travel together here. Acknowledge a claim within 10 business days, pay an agreed settlement within 5 business days, respond to the commissioner within 15 working days. Finally, the consequences. The commissioner can act against your license for a long list of causes: misrepresentation or fraud in getting the license, misappropriating or converting money that belongs to clients or insurers, a felony or certain misdemeanor convictions, committing an unfair trade practice, or general dishonesty and untrustworthiness. The commissioner can censure, suspend, revoke, refuse to renew, and impose civil penalties. And recall the after effects we covered. Revocation means no reapplication for 2 years and then a $20,000 bond. Recap the timeframes because they are the most testable items. Acknowledge a claim within 10 business days, pay an agreed settlement within 5 business days, answer the commissioner within 15 working days, and recap the labels: rebating, misrepresentation, twisting, defamation, unfair discrimination. Let's close the content with the test itself, because knowing the structure calms the nerves, and a few of these facts are themselves testable. Minnesota contracts with PSI to administer the licensing exam. Your life exam contains 75 scored questions. Of those, 50 cover general insurance knowledge, the national material you are studying elsewhere, and 25 cover Minnesota law, the material in this video. That is the split worth remembering: 50 general, 25 state, 75 scored in total, and the exam also mixes in a handful of unscored pretest questions that do not count, so do not panic if a question looks unfamiliar. The passing score is 70%. You need 70% to pass, and you will know whether you passed before you leave, because PSI gives you your result at the end. A few procedural facts that double as exam answers. You must complete your 20 hours of pre-licensing education before you test. Your passing result stays valid for 3 years, so you have time to finish the application, but do not let it expire. Minnesota requires fingerprinting for a criminal background check as part of licensing. You will bring 2 forms of identification to the test center, one of them a government-issued photo identification. And once licensed, you are back on that 2-year clock, renewing by the last day of your birth month with your 24 hours of continuing education, including the 3 ethics hours completed. Recap the exam facts. PSI administers it, 75 scored questions split 50 general and 25 Minnesota, 70% to pass, results valid 3 years, fingerprinting required, and renewal every 2 years in your birth month. Let's bring the must-memorize numbers home in one pass, because if these are locked in, your 25 Minnesota questions become 25 easy points. Pre-licensing is 20 hours per line, and your exam results stay good for 3 years. Continuing education is 24 hours every 2 years, with 3 in ethics, and no more than half from company courses. The grace period is 1 month. Incontestability is 2 years. The right to cancel is 10 days, and 30 days when it is a replacement. The suicide provision is 1 year. The Guaranty Association protects up to $500,000 overall, and for death benefits, $130,000 for life cash surrender, and $250,000 for annuity cash surrender. On a replacement, the replacing insurer notifies existing insurers within 5 working days. On claims, an insurer acknowledges within 10 business days, pays an agreed settlement within 5 business days, and answers the commissioner within 15 working days. And the regulator is the Department of Commerce, led by the Commissioner of Commerce. Go back through those once more before test day and say the contrasts out loud. Minnesota's death benefit guarantee is $500,000, not $300,000. Its suicide period is 1 year, not 2. Its free look is 10 days, or 30 on a replacement. You have done the hard part by studying the difference instead of the generic, and that is exactly what gets you across the line. You walk into that exam ready. If this breakdown helped, give it a like and subscribe so the next state and line is there waiting when you need it. Good luck. Go pass your Minnesota Life exam.